JP Morgan believes that there is a 60% chance the US will enter into a recession this year, something we've also noticed with Goldman Sachs. They put it down to around a 45% chance, and we also have the former Fed Chair Yellen warn the exact same thing, that there is a very high probability that the US will enter into a recession, and that ultimately is caused by the uncertainty by these Trump tariffs. And what this has done for the consumers in particular is make them very worried, at least for the shorter term. They're unable to understand where the prices of consumer goods are going to go. Should they be bulk buying before we see the implications of these tariffs? And also anxiety about whether or not we will start to see unemployment rise. And JP Morgan have also confirmed this when they've taken a look at some of their own models. They can see that consumers are getting increasingly worried about the overall picture of the economy, and in turn has really ramped up fear. But it's also something we continue to hear from earnings calls from the latest companies that have been releasing them. We had PepsiCo, where they highlight consumers are cutting back on their products, buying less and less, something that is mirrored in many of these companies that have reported over the last few weeks. We have Chipotle saying they have started to see a bit of a slowdown where consumers are effectively spending less, and their same-store sales are down for the first time since 2020. Again, we heard the exact same thing from McDonald's earlier today. Their same-store sales are down, the largest drop since 2020, and that the consumer is becoming a lot more cautious. Again, we can show you the exact same narrative being told when Starbucks released their earnings. Their same-store sales also fell for the fifth straight quarter, and this has also come through the US economy, where it has decreased 0.3% in the first quarter. And there are no surprises, but this policy uncertainty is weighing heavily not just on the consumers but also on businesses, really struggling to see how they're going to be able to afford a lot of these additional costs that are being placed on them. And on top of all of that, stocks have now had their worst 100-day start since the early 1970s, where President Nixon was in administration. And that word is brought about again, uncertainty, which has also become volatility in the market. We've also noted that China's manufacturing activity has started to reduce, and this is as a direct result of the tariffs, where Donald Trump and the administration are looking for products to be manufactured in the US, which, whilst may sound very good in theory, it will only increase the prices as labor costs are a lot more expensive. As we can see, just for the iPhone alone and purely on the labor perspective, it would be an additional 25% more than it is currently priced at. And we have other analysts who believe that the US made iPhone will come to $3,500. So at the moment, it does seem that the consumers are the one that are currently being hit hard the most, and maybe it makes sense why they're a lot more cautious, and perhaps anxiety is something that is warranted. And we've also heard that Donald Trump himself personally spoke to Jeff Bezos, where Amazon were reported in fact to show the additional implications of the tariffs on the goods you'd purchase. So for example, if you were going to buy something, it would show the additional costs that have come about from the tariffs, not something the administration liked to hear, and they went out as far as saying this is a hostile and political act by the company. And then we had Amazon later come out to say that these were never approved and that this plan was not going to happen. Having said all of that though, we do want to make you aware that the majority of the period in the market is typically one of a bull. In fact, 91% of the time we are in a bull market as opposed to a bear. And if you wanted to see the latest recession, you would have to go back to the Great Recession 07-09, where we can see a very large drop to the overall market. The other thing that we would say is, on average, recessions do typically last around 10 months, where growth drops around 2.5%, but jobs is one thing that is significantly lowered. In fact, net jobs, so we see a loss of jobs by around 3.9 million, but on the flip side, when we do get the expansion, which lasts a lot longer, GDP growth is very substantial. Net jobs added is quite some way larger. So today we want to run through 6 stocks that we believe are fairly recession proof based on historical data. As we can see, the first one is in fact Qualcomm, which was down 21% in the latest recession 07-09, with the S&P in comparison down 55%. This is also a company that has been increasing those dividends for the last 21 years. They increased it, in fact, during that latest recession, and they also had recession sales -7%. Whilst not particularly great, that was well above the average of the S&P at -12%, and they're also on a fairly substantial dip today given their earnings release. Over the last year, down 17%, year to date, down 11%. Over the last 10 years, though, they are up around 96%, and we do notice all-time highs last year around $230, and at the moment trading at the lower end of the 52-week range, a double buy from Seeking Alpha as well as Wall Street, and we also notice their forward P of 11.6 is below the 5-year of 15.3. This is typically what we would call a severe undervaluation signal, coupled with the fact the yield of 2.61 does sit above the average of 2.12, so 2 undervaluation signals noted. And when we look at this other valuation model, which does have the blue tunnel giving us the expected fair price based on the 5-year average, we can see for the first time in quite some time over the last year, this company does sit below even the bottom end. We're seeing disparity, and that again is another severe undervaluation signal. And our intrinsic value for Qualcomm does come to $202, purely the average of the 4 models that you see on screen. Now, given the current price at $135, we always like to apply an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, in today's episode, a buy at $182, but we go until it's near the current value, and as we keep going for the company today, we can see you're getting near a 35% MOS at $131, but as of now, 30 to 35%, with Wall Street themselves still very bullish, $197 price target, they see 46% upside. So Qualcomm, stock number 1, 30-35% MOS, 46% upside. In your opinion as well, let us know below if you see this as a buy, hold or sell. Also, to let you know, we have just released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of May. We've just released this earlier today. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving to is Accenture, which was down 31% in the last recession. As highlighted, S&P much larger, -55. They've been increasing those dividends for the last 19 years, increased it during the recession as well, and pretty much had average sales at -12%. The company itself is up only 1% over the last 12 months, and year to date down 14%. Over the last 10 though, massively outperforming the S&P, up 216%, trading near their 52-week low with a double buy from both Seeking Alpha as well as Wall Street. And we also get another undervaluation signal. Forward PE does sit below the 5-year average, as well as the yield, one of the highest on offer over the last 5 at near 2%, whilst also giving us that undervaluation signal here. Again, not often we do see disparity between the 2 points, and that is what we note. So Accenture, 3 undervaluation signals. Now, our intrinsic value, and as always, you can grab a copy of this model to run your own numbers through, whether for Accenture or any others, comes to $377, which should give a fairly attractive margin of safety, pretty much around the 20% level. Wall Street themselves see this at $360 over the next year, with their buy rating translating to 19% upside. 20% MOS, 19% upside. Accenture, in your opinion, a buy, hold or sell. We then move on to Bristol Myers Squibb, -32%, with the S&P -55. 54 years of paying a dividend without a reduction. They did unfortunately maintain the dividend during the last recession, didn't cut it, didn't increase it, and they also had below average growth. Currently they're up 12% on the year, year to date down 12% in fact, and over the last 10 years they are down -26%, but will depend at which point you did buy. Currently though, they are trading in the mid to low end of the 52-week range, with 1 buy rating from Seeking Alpha, and whilst we won't go into detail like we do in previous episodes, we can highlight very attractive grading, A on valuation, A+ on growth, and an A+ on profitability. We also highlight again undervaluation with the forward P at 7.5, 5-year at 8.4, yield at 5%, well above the 5-year at 3.27, and a third confirmation of undervaluation as we can see just below the bottom end, so Bristol Myers Squibb does look like one for further consideration, and our intrinsic value gets to $63, again the average of these three that you see on screen, and we will get a fairly attractive MOS again at 20%, pretty much a buy at $50. For those looking at 25, you would have to wait for 47. 20% MOS, we did see a fairly attractive yield near the 5% point. Wall Street forecast $60, 22% upside. We then move on to Taiwan Semiconductors, where they were down 25% in the last recession. S&P much further, negative 55. They've been paying a dividend for 21 years without a reduction, but they did in fact cut it during that 07-09 period, and they had below average growth at negative 26. Now they are up 28% over the last 12 months, year to date down 12, but over the last 10 years, massive outperformance of the S&P, up 607%, trading in the mid to lower end of the 52-week range. A double strong buy from Wall Street and Quant, a buy from Seek Alpha, although near the 4.5 to flip this into a strong buy, and again forward P of 18.4 below the 5-year average of 22.1, although we do notice the yield is slightly below the 5-year rolling at 1.8, and we get that undervaluation signal here. Nice to see the blue tunnel increasing over time. That is ultimately what you want from your companies, but as we said, undervaluation does look to be the case for TSM, and our intrinsic price of $225 is some way in fact above the current at 173, and in terms of an MOS in today's episode, a buy up to 180 for 20% margin of safety. At 25%, we do see it near there at 169, so 25% or near enough MOS. Wall Street themselves, as we saw, double strong buy rating, $242, in turn 40% upside. Now we had to include Walmart today as it is the only one we have come across that actually returned a positive performance, up 7% when the S&P was down negative 55. They've also been paying a dividend for the last 51 years without a reduction, increased it during the last recession, and pretty much had flat sales, as we said, S&P negative 12. Now they're up a massive 65% over the last year, year to date up around 8, and over the last 10 years outperforming the S&P up to 172, whilst trading up the upper end of the 52-week range with just one buy rating from Wall Street, but again 4.4 rate, not that far from a strong buy rating. And we do have to point out their forward P is significantly above the 5-year average, as well as the yield sitting well below the 5-year 1.5, so a double potential overvaluation signal. And this is also confirmed when we take a look at this model. In fact, for this company to have been reasonable signal, you would have to go all the way back to literally 1 year ago today. And that's also reflective when we get to our intrinsic value, $92. The current share price does sit higher, so we're effectively saying the company does trade at a very slight premium. For those that did want a margin of safety of 10%, a buy at $83, at 20% around $74, and at 25 around the $69, $70 mark. Now it is one that does look to be recession proof based on historical data, but the key here is to buy this at an attractive price. Probably not at this level, you do want some kind of margin of safety, yet Wall Street with a near strong buy rating see this at $112, 15% upside over the next year. Finally, we get to MasterCard with a fairly strong recession performance, negative 12. They have also been paying a dividend for the last 18 years, maintained it, didn't increase it, didn't cut it, and also above average growth at 2.1%. Now they did report their earnings and they are pretty much flat on the day, but up 24% over the last year. Year to date, up 4%. Over the last 10, massive outperformance of the S&P, up 484. Trading at the upper end of the 52-week range, double buy from Seeking Alpha and Wall Street, pretty much with a forward P and in fact their yield both in line or thereabouts with the 5-year average. And we also get to a similar conclusion when we take a look at this model. All three that we have seen for MasterCard, we would say a high quality company, does show a reasonable valuation signal. Now intrinsic value today comes to $621 derived from the DCF. Now we'll show you as we're using one model, we have the free cash flow year on year. Average growth at 16%. Moving forwards, we have gone for 14, but as always, we have the figures here for low, medium, and high, 12, 14, 16 respectively. Numbers, as always, are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for MasterCard or any others. 14% growth rate with the discount rate. We get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, $621, indicating 14% upside. Full transparency, for those that want to see it at a lower rate, 12%, $538, not that far off the current price. So if you're buying it right now, already baked into the numbers is growth of 12% moving forwards. And for those that want to see it more in line with the average, $716, 31% upside. As typical though, we will use the median rate of 14%, and doing the MOS in today's episode, you can in fact see not at 15% just yet for MasterCard, somewhere between 10 to 15, with Wall Street themselves, $630 price target, they see 15% over the next year. But give us your thoughts, MasterCard in your opinion, a buy, hold or sell? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon as well where we cover our weekly buys and sells, and as always have a great day, we'll see you all on the next one.